Today, we are diving deep into one of the fastest growing and, let's be honest, most complex corners of the financial world: significant risk transfer, or SRTs for short. It's a really powerful tool for banks, but it's also got global regulators paying very close attention. So let's get right into it.
Let's just kick things off with a number that should really grab your attention: $70 billion. That's the size of this market right now. To put that in perspective, that's bigger than the entire economy of some countries. And it's not just that it's big, it's growing at a pace that's just leaving more traditional financial products in the dust.
So, to really get our heads around this, we're going to look at the market size, break down how these things actually work, check out the recent boom over in the US, hear the warnings from the IMF, see how regulators are scrambling to respond, and finally ask, what is the real risk here?
All right, first up, just how massive is this market and what's fueling this incredible growth?
Well, in 2024 alone, we're on track for nearly $30 billion in brand new deals. Now, that is pretty staggering, especially when you compare it to the traditional securitization market, where banks just package up and sell their loans. That market's been growing way more slowly. It's a huge sign that there's something really special and really different happening with SRTs.
Okay, so what in the world is one of these transactions? I know, at first glance, it can seem insanely complicated, but the basic idea is actually pretty simple once you break it down. So let's do that.
So, at its very core, an SRT is just a clever way for a bank to manage its risk and its capital without actually having to sell its loans. See, the bank keeps the loans, but it passes the risk of those loans going bad to an investor, someone like a pension fund. The bank pays a fee for that protection, and in return, it gets a massive benefit.
I love this slide because it makes it so clear. Imagine the bank's loans are all sitting in a box. Instead of selling the whole box, the bank buys an insurance policy on it from an investor. By paying that premium, the bank doesn't have to hold on to as much cash just in case something goes wrong. And that freed up capital, that's the whole point. It can be used for new loans, which is great for the economy, or it can just go straight to boosting the bank's bottom line.
Now, this shows a really crucial difference in how these deals get put together. In a funded deal, the investor puts up cold, hard cash right at the beginning. It's like a security deposit. If things go bad, the bank uses that cash. But in an unfunded deal, there's no cash up front, just a promise to pay later if needed. That one's built a lot more on trust, and as you can imagine, regulators are paying very close attention to that distinction.
For years, Europe was basically the center of the SRT universe. But that is changing, and it's changing fast. Let's look at the story of how the American market pretty much woke up overnight and decided to join the party in a huge way.
This chart really says it all, doesn't it? Historically, Europe was responsible for like 85% of all these deals. But just look at that shift. The US share has basically doubled, and it's now about 30% of the entire global market. That is a seismic shift in a very, very short amount of time.
So what happened? What lit the fuse? Well, it really all comes down to a key decision from the Federal Reserve in late 2023. Before that, US banks were super hesitant. They just weren't sure if regulators would give them the capital relief they wanted. But in September 2023, the Fed gave the green light. They clarified the rules, and with that certainty, bam, the floodgates just opened, leading to the absolute boom we're seeing this year. Now, all this explosive growth, it hasn't gone unnoticed, and frankly, it's raising some eyebrows. Some of the world's most important financial watchdogs are now asking some really tough questions about whether this is creating new, hidden dangers in the system.
And this gets to the absolute heart of the debate, doesn't it? Is the risk actually being transferred out of the banking system to investors who can handle it, or is it just being shuffled around, hidden inside a complex web of transactions that could completely fall apart in a crisis?
And here's the warning, straight from the International Monetary Fund. They're worried about these negative feedback loops. The fear is that the risk never actually leaves the building at all. It might look like it's gone, but it could come roaring right back when everyone least expects it.
The IMF is pointing its finger at something called back leverage. And here's how it works. An investor agrees to take on Bank A's loan risk, but to get the money to do that, they go and borrow from Bank B. So you see what's happening? The risk never actually left the banking system. It just got moved around, creating this hidden and potentially very fragile chain of risk.
Okay, so in response to all these growing worries, you can bet regulators are on the case. Especially in Europe, where the market is more mature, they are actively trying to update the rule book to keep up with all this innovation.
Over in Europe, regulators have been thinking about this stuff for a while. The European Banking Authority, the EBA, has been setting rules for these deals all the way back since 2006. Their main goal has always been to make sure that when a bank says it has transferred risk, it's not just some kind of financial magic trick.
A really key rule here is something called the P factor. Now, stick with me, it sounds technical, but think of it like a complexity tax. Regulators want to make sure that doing one of these complex deals is a little bit more expensive for banks, capital-wise, than just holding a simple loan. It's to account for all the extra moving parts. And the lower that P factor, the lower the tax, the more attractive these SRTs become. And this table is fascinating because it shows how different rules are creating totally different playing fields. The US has a lower P factor, that lower tax, which gives its banks a real advantage. The EU has a higher one, making these deals pricier for their banks, although they are talking about changing it. And then the UK is looking at a whole new flexible approach. These tiny little differences in the rules have a massive impact on where these deals get done.
Okay, we have covered a ton of ground. We've gone through the mechanics, the market boom, the regulatory debates. So what are the crucial things you need to remember about SRTs? Let's boil it all down.
So let's recap. We've got a market that is absolutely exploding. And a big reason for that is the US finally jumping in with both feet. But that growth has sparked some serious worries about hidden risks, like that back leverage we talked about. Now, regulators are basically playing catch-up, trying to make the rules smarter. But for the banks, let's be clear, it all comes down to one thing: capital. This is all about freeing up money to put to work somewhere else.
And all of that leaves us with one final, pretty provocative thought to chew on. SRTs are, without a doubt, a powerful and efficient tool for banks. But the warnings from groups like the IMF are a stark reminder that financial innovation almost always comes with hidden trade-offs. So the question is, have we really built a system where risk is truly transferred to those who can bear it? Or have we just created a more complex shell game, where in the next crisis, we'll discover the risk was in the house all along?